welcome everybody. Welcome to the Saffery Budget webinar. Just a little bit of housekeeping to start with. The webinar is being recorded. It will be on our website for up to a year. No attendees in the room can be seen or heard. There isn't a facility to take questions during the session, but if you have a question, please either contact your normal Saffery contact or the events people there, or me, adam.k@saffery.com, and delighted to help. And everybody, whether live or online, will get an email with a link to the recording should you wish to watch it again or forward it to friends, relations, or pets. And that will happen within 24 hours. So thanks very much. A sort of few opening remarks, really. This has been an absolutely chaotic run-up to a budget. I've been doing the budget now for, I've been at Saffery's for 21 years this year. This is my 21st budget that I've been involved in, and it is the worst I can remember. And that is just not necessarily what we got in terms of the content, but just the constant leaks beforehand. That, you know, if you look at what we didn't get, but we were expecting in the budget, we were expecting an increase in the main rate of income tax. We were expecting an exit tax. We were expecting an increase in CGT rates. Yesterday morning, The Guardian published an article saying we were going to get a removal of the base cost uplift on death. We were expecting NIC on partnership profits. We were expecting a lifetime giving cap in the same way as the US for inheritance tax, and taper relief changes for pets. Again, articles yesterday on this very subject. And these were deliberate leaks. The government, we have it on good authority, is they deliberately float stories in the press in order to sort of see what gets traction. And you know, I'm aware personally of 6 clients who left the UK last week because they were worried about the exit tax. Those of you who are lawyers will know from your legal teams they were doing all-nighters over the weekend to try get gift transactions through before the budget. It was astonishing, really, as a way to prepare. And so, you know, getting the OBR sort of report half an hour early did really sort of add to the general sense of, crikey, what in heaven's name is going on. Nevertheless, you know, there is quite a lot of interesting stuff in the budget, and we've got hopefully a little bit of time this morning to go through it. What we got was perhaps a little bit less exciting than the stuff we could have got. So I was sort of looking forward to reveling in the chaos or the sort of skies falling of capital gains tax and IHT apocalypse. But nevertheless, we've got a bit of income tax changes to talk about, so that'll keep us going for a while. There's also a section in the budget which I particularly enjoyed called Cutting Waste, which included the line that the government's going to invest £18 million over 2 years into 200 children's playgrounds across England. Those of you who've had a coffee this morning will understand that that is about £90,000 per children's playground that the government is going to invest in. One of my fellow tax partners is a local councillor in Cambridge, and he said it's quite a lot less than £90,000 to build a children's playground. So there's a sort of enormous cost, but nevertheless it's a good, laudable aim to create those things, so I suppose it's swings and roundabouts, really. Sorry. Okay, good. So we'll start this morning with personal tax and with personal tax rates. So the Chancellor, sorry, I couldn't meet your eye there with that joke. So the Chancellor said it was very clear that she kept her promise not to raise the main rate of income tax in the budget yesterday. But in the same way that my children, when they promise to clean their room and you go in and you look under the bed and it's full of dirty clothes and cutlery, not quite as clean as you might have wished or hoped, there were some quite significant income tax changes which are going to raise a lot of money. So the first one, which I always talk about every year, is fiscal drag and the freezing of personal tax rates. And I'm convinced that, you know, in 50 years' time, my grandchild will be doing this budget webinar from her Sky Citadel, having sort of commuted by jetpack and announcing another freeze in the income tax rates and bands. But nevertheless, it's now out to 2031, the current income tax band freeze. So yes, there you go, £12,570 for personal income tax allowances, higher rate at 50 grand, and the additional rate seems to be coming down now. So it was down, I think last year or the year before, to 125,000, and is still there. There is the entertaining interaction with devolved taxes. So, of course, for some taxes in Scotland, and I think Wales now, they can adjust their own, they can have their own bands for certain kinds of income. Scotland has exercised that right, Wales has not. Northern Ireland, I think, are next in a couple of years. So that also is something to bear in mind. And the NIC bands and starting rate for savings are also frozen. There was a great line from Henry Mance in the FT, who I always quote at these events now. I think this is the third consecutive year that I've quoted Henry Mance. He was talking about Kemi Badenoch's rebuttal to the Chancellor's speech, which was quite forthright in her sort of standard style, which she does, quite entertaining. She said that, respect must be earned, she said to the Chancellor. And Henry Mance said, well, watch out, because then the Chancellor will tax it. So in addition to personal tax rates, we have a new income tax rate, a brand new income tax rate. So this is congruent with the Chancellor's often stated desire to reduce complexity. So we move from a world of non-savings, savings income and dividends to four. We now have non-savings income, savings income, dividend income and property income. It's to be introduced from 6th of April 2027, and the rates are going to be 2% higher than currently. I have absolutely no idea why the start date is deferred by 15 months. I cannot fathom, if you're going to do it, why do it so the first additional tax payments are shortly before the next election? Because we've got an election in the summer of 2029, and the first tax payments will be January 2029. So just fresh in everybody's mind, about to make your second payment on account in the of the new property tax, and why you wouldn't want the tax revenue a year before, I cannot fathom, but there we are. There was a quote from the National Residential Landlords Association from Chris Norris yesterday, and just pointing out that for property landlords, we have had the removal of wear and tear allowance, we have had the removal of the landlord's energy savings allowance, that's 2016, increase in CGT rates, reduction in CGT annual exemption, and the cutback of finance cost relief for private client landlords in the last few years. And so here we have another 2% tax rate on tax increase on private client landlords. So again, there appears to be a desire within government to move towards a sort of corporate landlord. So you have large corporate landlords, which of course wouldn't be affected by this. And so, again, it's another push to looking at corporate structures for property rental rather than holding these things individually. It is, again, a devolved tax. So again, Scotland, for example, can only set its own rates and bands for non-savings income, so trading and employment, but they can now do this for property income as well. So Scotland will no doubt then set their own bands and rates for property income, which might or might not be the same as England. So again, watch this space. And there's also, as a sort of prize winner point at the end, they're changing the way that you order tax reliefs. So normally you can offset tax reliefs in the most tax efficient way, so against your earnings first, and then your savings, and then your dividends. It's now going to be earnings, property, savings, and then dividends. I don't know why. It may be it's for an NIC thing, so you're offsetting your losses in the same way for NIC as you are for income tax, but it does mean that it's not the most tax-efficient way, because the earnings are taxed at a lower rate than the property. So there you go. That's that one. And again, so another change to tax rates, and again, some slightly odd decisions. So we're going to have a 2% tax rise in tax for basic and higher, but not additional rates of dividends. So for some reason, we're not going to increase the tax rate, the additional tax rate on dividends. Again, there's probably some sort of 4D chess clever reason why they're not going to increase the additional rate of tax on dividends, but they have chosen not to. So the rates will be 10.75, 35.75, and our good old, well-beloved 39.35. Then again, that happens from 2026. So not the same as the property income tax rate change date. It's a year earlier, but it does give you 3 or 4 months to pay a big dividend before then. The most interesting number of all of those three dividend tax rates by a long way is 35.75, because that is the loans to participators charge rate. So if you've got a loan from a closed company to a participator, you're taxed at the higher rate of dividend tax, so that goes up by 2%. So loans to participators in closed companies become more costly. And then I haven't done savings income yet, which is different again. And so this is all three rates, so your interest income tax rate goes up by 2%. That is 2027, not 2026, for some reason, and is basic, additional, and higher. So different to the dividend. So yes, that will be sort of prize winner points and making sure that you get your tax calculations wrong, and whoever's job it is to update the tax software is going to have a fun few months. More on income personal tax sort of changes to ISAs. This was quite an odd announcement. The Chancellor was quite sort of bullish when she announced this in her speech. She was sort of presented it like it was a good thing that she should be, that she was giving to everybody. But it's not. It's not a sort of beneficial change. It is actually a restriction in ISAs. So firstly, the amount that you can put into a cash ISA is going to be reduced from 20,000 to 12 for under 65s. But then the remaining 8,000 of your ISA allowance will have to go into a stocks and shares ISA. You can still do your junior ISA rate, junior ISA, which is, I think, 9, and the lifetime ISA is still 4. Those are staying the same. But for under 65s, you can only put 12 grand into your cash ISA. And again, I'm saying frozen again, and so the limits are again frozen for ISAs until 2031. So again, not great for savers. Salary sacrifice. For those of you who are playing start date bingo while you're enjoying my talk this morning, you might see yet another start date for a tax change. So currently the rule is that if you are an employee, you can sacrifice some of your salary if you do it correctly and structure it correctly in exchange for your employer making a pension contribution on your behalf into your personal pension. Because it's an employer contribution, you obviously don't get income tax relief on that, like in the same way as other employer pension contributions, but it's made out of gross income, as in you don't suffer an income tax charge. So that kind of balances. The income tax balances on salary sacrifice for pensions, but the employer doesn't have an NIC cost, and that's the saving for a salary sacrifice into a pension. That limit, that NIC benefit is going to be restricted to the first £2,000 of salary sacrifice pensions per employee per year from April 2029. Again, weirdly late. So for some reason that is going to happen. Although in this case, there are some reasons why you might want to give some time for employers to sort of adjust what they're doing, although whether they need 3 years is debatable. Because there are still going to be situations in which this is beneficial. And so employers may not have a facility for calculating or withholding employees' NIC on salary sacrifice, but there are still going to be quite a lot of situations where employees are going to want to do it. For example, if you are at £100,000 worth of income, your free childcare falls away at £100,000 of income. So if in London, if you're paying London childcare prices, and you go from 99,999 to £100,000 of income, the cost, and you're using the free childcare, you have to earn 149,000 before the pay rise is worthwhile. That's because of the cost of the childcare. So you want to reduce your income by as much as possible to get yourself below the limit, and salary sac is one of those ways of doing it. Gift aid's another. And so for those employees, large salary sacrifice is still going to be a thing, so employers are going to have some way of sort of offering that to their staff, ideally. And there's also other situations as well in which you might want to make a salary sac claim. For example, if you're in the high income child benefit window where you pay those ridiculously high rates of marginal rates, or if you're in the winter fuel allowance, which is now going to be deducted via income tax. So you're going to have a winter fuel allowance charge if you earn more than £35,000. So again, we'll be asking every one of our wealthy clients who are over 65 whether they get the winter fuel allowance this year, which will be slightly odd. Anyway, so there we are. So salary sac still going to be a thing, I think, for a lot of people, but now it's going to be more complicated and more expensive, which is jolly good. I have a few slides on property taxation now. So one of the things we were promised in the budget, we were really looking forward to it this year, was a mansion tax on wealthy individuals. And we did get one. Not as large as it could have been, which is disappointing, but nevertheless we did get one. And that is the High Value Council Tax Surcharge, the HVCTS. That is a new charge on properties worth £2 million or more. It comes in from April 2028, which is fair enough actually, because it's going to take them a while to get ready. It's collected by the local authority, but they don't get to keep it. They have to give it to the government when they receive it, which seems a bit harsh. They are apparently going to be compensated for the cost of collecting it, so you can expect that invoice to be rather large when it goes to central government. It is paid by the homeowner, not the person living there, so it's another tax on landlords, although one which perhaps might be a little bit easier to pass on to the tenant than the 2% income tax charge. How will the government know whether a house is worth more than £2 million? Well, I'm glad you asked me. That is the Valuation Office are going to conduct a targeted valuation exercise next year. There are 29.9 million houses in the UK. 140,000 of them worth more than £2 million, apparently, according to Copilot this morning. LinkedIn tells me that there's about 3,800 people who work for the Valuation Office, and about 60% of them are surveyors. So I did actually worry whether or not the Valuation Office would be able to do this in 2026. But based on those numbers, they only have to do 124 each to check if you assume a 50% sort of hit rate. So maybe doable, but they're going to be super busy unless they're just looking on Rightmove, depending on what a targeted valuation exercise actually is. But nevertheless, there they are. So they are going to do a valuation exercise, tell you whether you're caught, presumably, and they're going to revalue your house every 5 years to tell you what the charge is and what are the charges. They are there. So if your house is worth between 2 and 2.5 million, it's £2,500 of extra council tax, and it goes up to £7,500 of extra council tax for the most valuable homes. There's going to be a consultation exercise for exemptions. For example, people who have to live in a particular place for their work will be exempt. So lighthouse keepers, farm workers, chancellors of the Exchequer, people like that will qualify for an exemption. And there'll be a sort of time to pay arrangement for those who are property rich and cash poor. So there you go, that's the HVCTS. There's also quite a welcome change, actually, in a sort of tone shift in this talk. There's quite a welcome change for ATED, the annual tax on enveloped dwellings, which is the mansion tax we already have for properties worth more than £500,000 in corporates. Currently, there's a charge which applies every year. Reliefs apply to sort of normal businesses like property rental businesses and things like that. You don't have to pay an ATED charge, but if you are exempt, you have to claim a relief, and you have to claim a relief on an ATED return, and you have to file that return within 1 year of the end of the period. And so if you are late, you might still have a liability, but timed out of claiming the election. So you're now going to be able to claim those elections late, which is good because it stops people who would otherwise otherwise would have qualified for an exemption having a charge. So that's positive, and that comes in straight away, which is even better. So there you go, a ray of sunshine for my talk already. So that's jolly good. Moving on to image rights payments, which there is no technical note in the budget about this. The word footballer does not appear, but nevertheless, there is quite a significant change to the taxation of footballers and other sports people who, or people who receive image rights payments from their employer, although mainly footballers probably. So not sure if you're aware of the way that footballers tend to operate, or sort of footballer structures tend to operate, but generally in a footballer's contract you get a payment for playing football, and you also allow the club to use your image rights to publicise their business and the league and things like that, and you get a payment of usually up to 15%. There's a transfer pricing exercise, quite complicated, but there's a sort of 15%-ish that's been negotiated by HMRC and the FA as what's a reasonable sort of level for an image rights payment. And typically what a footballer does is they put those into a company, and it's quite a nice structure because footballers tend to be cash rich and time poor. the company can be managed, and it sort of rolls up like a pension. So when they retire, there's a pot of money available for them to live on, and it's taxed quite efficiently. So those structures are very common and not particularly tax motivated, but more in the sort of wealth management type structure that companies that footballers have. However, according to the budget, to a line hidden away right at the end of the budget document from April 2027, all payments made in respect of image rights from an employer to an employee will be subject to income tax as salary. That includes deemed employment, so IR35 type stuff, I assume. And I don't know if you were trying to do it through an LLP or whatever that is. So that's going to be quite a big change. There's going to be, excuse me, I'm messing around with my microphone, apologies. There's going to be probably quite a lot of work done on the sort of lobbying side between now and 2027 when it comes in. It is the policy costing document has a few extra sort of details about it, which says that which implies that it only covers payments made by the employer to the employee. So there's quite a lot of work that's being done overnight thinking about this, and so perhaps, for example, if you're a Manchester United player, your shirt is sponsored this year by Snapdragon, so could you be paid for having Snapdragon on your shirt by the Snapdragon themselves, not them paying the company and then the company paying for your image rights? That sort of shift of footballer contracts is likely to happen as a result of this. It probably doesn't. Again, we need some details, but it probably doesn't affect your third-party endorsement income. So if you've got personal sponsorships and things like that, probably not caught by this. If you are a newly resident footballer signed from overseas, you'll also be looking at overseas workday relief for the first 4 years, I think it is these days. And so, if you've got image rights payments in respect of Champions League matches or something like that, then those are probably going to be exempt. So yeah, quite a lot of detail and quite lots of sort of change, but again, significant change for sports and entertainment clients generally. I think from the sort of slightly sort of back down to earth with the crunch, we've got the loan charge review. For those of you maybe not aware of this was to do with some quite egregious tax. One struggles to use the word avoidance, but maybe even worse than avoidance structures, which were put in place during the sort of 2000, late 2000s and the sort of 2010s. In fact, you still see them now, where employees were encouraged to settle their earnings, or traders encouraged to settle their earnings onto overseas trusts and receive interest-free loans instead. And the way that these schemes purported to work was that the loans were not, that the earnings were transformed into tax-free loan payments by going through these trust structures. It's a real scandal. There's a lot of mis-selling. A lot of the promoters have just simply gone back, put their companies into liquidation and started up elsewhere, leaving taxpayers who were promised very, very tax-efficient structures and sort of no tax to pay, with multiple years' worth of tax liabilities and penalties. The sheer volume of the structures and the sort of purported differences between them, although in practice they weren't very different, has meant that we've got this loan charge, which is a one-off charge to people who used these disguised remuneration structures, and it's a very significant issue. There's been quite a lot of pressure in Parliament about it. There's been some suicides. It's very tragic from people who've been stuck with liabilities. Ray McCann, who I've never met but interacted with a few times and seems like a thoroughly decent human being, who was formerly head of the CIOT, has been asked to conduct a review into the structures and has come up with a new settlement opportunity. So the draft terms of the settlement opportunity were endorsed by the government yesterday. In fact, they went a little bit further in some cases. And they say that if you come forward and settle your liability, your tax will be based on the rate at the time you should have had the income, not the 2019 loan charge rate, which might be a bit lower. You get a tax reduction for historic promoter fees. I think they mean historical promoter fees, but there you go, of up to £10,000, because you will have, If you're a user of these structures, you will have paid the promoter for the scheme, which might be some or all of your tax saving, and then you get clobbered with the tax saving later on, the tax liability later on. So you get a deduction for those of up to £10,000, just an additional flat deduction of £5,000. You won't pay interest. Some of the way these structures worked, and indeed I've seen HMRC enforcing it, is that not only can you be liable to income tax, you can also be liable to IHT on some of the structures because of the way the loans worked. That won't be charged, and there'll be sort of time to pay arrangements. So there's a cap on the reduction in liability of 70,000, but a lot of people, hopefully, will be incentivized to put this matter to bed and to pay out something. So hopefully that will be a happy outcome, as happy as can be expected outcome for people in this case. So how are we doing for time? We're doing super well. So some CGT points now. We've got a couple of prize winner points about capital gains tax. Employee ownership trusts. So these are structures which were put in place a few years ago, which allow business owners to sell a majority shareholding in their business to an employee benefit trust, and it's tax-free. And it was originally thought that when these structures were introduced, that the tax saving would be 100 million a year. It was about £1 billion last year in terms of, they've absolutely gone gangbusters as a structure, just because it's tax-free. So CGT rates have gone up since they were introduced. Entrepreneurs relief or business asset disposal relief has been really, really cut back, so the 10% rate's not really available anymore. So it's just a pretty huge tax saving, and as a way of exiting from your company, they have largely replaced MBOs in the UK. You don't see very many MBOs now, you see a lot of EOTs. They're still going to be beneficial. The relief has been reduced from 100% to 50%, taking effect from yesterday. So that might sort of spike them a little bit. There were some technical changes last year, which the government thought would put people off using them, but haven't at all. So maybe this will. The tax saving that they're budgeting is about £1 billion a year from this change. So it's quite a big sort of thing moving the needle. But nevertheless, I mean, it's still a 12% tax saving. I think a lot of people will still be interested in doing it. Worth bearing in mind that if you still have some business asset disposal relief left or investor relief, which I've still, since it's been introduced, never seen a claim, but hope to do so one day, those reliefs won't apply to gains which you claim EOT relief on. Some techie points for the capital gains tax nerds amongst you, if there are any here. One quite sensible change, which is being introduced from, again, weirdly, from 6th of April 2026, is that from now on you're going to have to claim incorporation tax relief. So if you incorporate a business into a partnership or a LLP into a company, then you're going to have to claim the incorporation relief rather than just automatically applying. That is, and the rule which says that you can elect out of it is going. That is going to catch people incorporating their property businesses because, again, we see so many now people looking to do that and claiming that their property business is a business and therefore qualifies for the relief, and now you'll actually have to claim it. That is going to open that up much, much more to HMRC to be able to challenge them. So it is from 6th of April 2026, so if you've got clients thinking about doing it, they might want to have a good old think before then. Not that we'll all be looking for things to do before April 2026, but there you go. It's another thing which people will want to do and is aimed at landlords, really, I think. There was quite a lot of chat about the change to share-for-share exchanges, which is our good old Section 135 for your CGT nerds again. So this says that where you've got shares in a company and you exchange them and you put a new company on top, you don't pay capital gains tax. The anti-avoidance rules have changed, been modernised. I cannot see very much difference between them. I must say, Robert Langston and I were looking at this last night and really, really struggling to see why they've done this. It seems to give HMRC more powers to counteract the avoidance rather than just saying you don't get the share-for-share exchange relief anymore. But there was a 5% de minimis. So if you had 4% of a company and there was a share-for-share exchange, the relief automatically applied. So even if it was being done for avoidance purposes, you still got the relief. That seems to have gone. So smaller shareholders are going to have to pay attention to stuff like this in future. Okay, some inheritance tax points now, and another freezing slide. So the nil rate band, which we all know and love at £325,000 a year, is frozen until 2030. Was frozen until 2030, and now fixed for another year in 2031. So this was last changed in 2009, so it has stumbled on for 16 years without being changed at the current rate. I thought it might be worth thinking about what happened in 2009, because it seems like quite a long time ago. Barack Obama became president of the United States in 2009. Bitcoin was launched so that everyone could become rich without doing anything, so that was jolly good. Minecraft released, which revolutionized parenting. And the best-selling album globally was I Dreamed a Dream by Susan Boyle. So a happier, more innocent time, I would say. 2000, well, maybe not happier, but a more innocent time, 2009. Two of my children were born after 6th of April 2009, which makes it astonishing to me that they've never known a world in which there wasn't a 325,000 nil rate band allowance. But there we are. Yes, so that's fixed until 2031 now. So hold on to your hats there. The other reliefs are also fixed. So the residential nil rate band still at, I think that's 175 grand. That's staying, and the BPR APR allowance also frozen for another year. On which topic we get the transferable rate. So as you'll all know by now, probably heard ad nauseam, the rate of business property relief and APR, agricultural property for inheritance tax, is being reduced from 100% to 50% from 6th of April 2026. So we have just finished the insane rush of trying to get gifts made before the budget, for no reason, it turns out, but hugely busy time. Every client should be looking at their will before April 2026, and quite a lot of them should be doing things. So please, if you do have clients and they haven't done the inheritance tax at all yet, please encourage them to do so, because you will not be able to get hold of a lawyer to do anything in January, February or March next year, I would have thought. So anyway, so there is going to be £1 million allowance per person, which still qualifies for 100% relief. That was not previously transferable, and indeed the government said they weren't going to make it transferable. They specifically said they wouldn't make it transferable, but they have apparently now realised that that was a silly idea and are going to do so. So that's a really positive thing. And just to give you an idea, so imagine if you've got a farm worth £3 million, owned jointly between husband and wife, now there will be no inheritance tax on that farm, because, I don't think, because husband passes away, potentially leaves his half to wife. She inherits not only his nil rate band and his residential property nil rate band, but also his agricultural property nil rate band. So 1.5 million of inheritance tax reliefs. And so she has her own 1.5 million of inheritance tax reliefs. And so you would hope that there would be no inheritance tax on that farm. I'm looking at people who know more about me than inheritance tax in the room, and they look puzzled. So perhaps I've made a mistake there, but no doubt, speak to your tax advisor, but I'm pretty sure that no inheritance tax on that in that scenario. But if you didn't have a transferable nil rate band, then what you would have to do is on the first death, leave £1 million worth of the farm to someone in the next generation. So you'd have to have these quite complicated sort of multi-level ownership structures between the family in order to make the farm tax exempt. So simplifies things greatly, reduces the amount of work that's needed, and so it gets to a good thing. So that's positive within reason. I mean, that's pretty much all you get as a farmer this year, but it's something. So there we are. We also have inheritance tax for farmland held via overseas vehicles. So this applies to individuals who are not long-term resident in the UK. So those individuals are only subject to UK inheritance tax on UK property. So for example, if they have assets, UK assets in an overseas company or partnership, then those assets will not be chargeable to inheritance tax for them. They'll be excluded property. You can always, or HMRC can always already look through offshore structures to tax UK residential property values on those individuals. Now but not other property. Now they'll be able to look through to get UK agricultural property as well. So if you've got people who are not long-term resident who own UK agricultural property through overseas vehicles, there's going to be, inheritance tax issues for those people going forward. We have lots and lots of quite techie points about international private client tax. Fortunately, we have loads of time, so that's great. We can really get into the meat of it. There was a great line in the budget document, which I'll read in full. There's a couple of them, actually, but the first one is, from April 2025, the government removed the outdated concept of domicile status from the tax system and implemented a new residence-based regime, which is internationally competitive and focused on attracting the best talent and investment to the UK, which is a jolly relief, frankly, for those of us who might have formed a mistaken impression that it was a politically motivated tax grab which was deterring people from coming here and had forced a load of clients to leave. So we were completely wrong, and it's all good. However, there is again, the government have thrown a bone to those of us who were concerned that the tax system was off-putting, and is an additional or a cap on the charge for offshore trusts settled by former non-DOMs. So if you have a client who was a non-DOM before 30th of October 2024 and had assets in trust, then if there are sort of 10-year charges or exit charges applied to that trust, they will be capped at £5 million every 10 years. So this is only going to apply to trusts which have got more than about £83 million in them. But nevertheless, those charges will be capped at £5 million. It is backward-looking. It starts from April 2025. The cap is per trust. So if you've got a lot of different trusts, each one is subject to the £5 million cap. I asked Steve Coelho in our international tax team, I said, well, Steve, I've got a great idea. Why can't you just put everything into one trust, and then you only have to pay one lot of £5 million? And he looked at me as if I'd sort of passed the port to the left in a sort of outraged way, and then said, as if I were a small child or a Labrador, that it doesn't work like that for inheritance tax, and they're still separate settlements, and so you still have to pay the £5 million. So that doesn't work. So more than one trust means more than £5 million, but it is there as a bone for those people. My fellow partner Claire Cromwell was saying to me this morning, it's maybe too little too late. Lots of these trusts were broken up before 6th of April 2025 because they'd take advantage of the non-DOM rules. All clients have already gone. But nevertheless, if you've got one who didn't take advice prior to April 2025 and hasn't left the UK and is still here, there you go. So that is a benefit for those. There was another point in the budget about a new tax offer for high talent new arrivals. Absolutely no details that I can find at all, but it did say it. The government will explore, it said, how to further develop its tax offer for high talent new arrivals to build on the success of the existing regime and to bolster the ambition for the UK to be blah, blah, blah. So anyway, so there is an enhanced offer apparently being thought about, so maybe watch this space. Slightly less happily for new arrivals, there's going to be a consultation into the sort of tax exemption which applies to offshore structures which are set up without a tax motive. So if I were to set up a structure overseas and that were to receive income, obviously I'm taxable on it in the UK because of the anti-avoidance rule, unless it was set up for a commercial purpose. And so that commercial purpose rule is going to be the subject of a consultation, so we will see what that says. There are some technical changes to the foreign income and gains regime, which I don't understand, but are in your notes, so that's jolly good. There are some other changes to the 5-year rule. So currently, if someone goes non-resident, it's a temporary non-resident, so they go non-res for less than 5 years. If they receive dividends while they're non-res, then those can be taxed if they come back. If they sell assets which they held while they were non-res, while they left the UK and then come back, those can be taxed when they get off the plane. The dividends, currently there is an exemption for post-departure profits. So if you go non-res and your company makes profits after you've gone, and then you take a dividend and you come back within 5 years, that dividend's not taxed. So that exemption's going. So even if the profits are earned before, while you were non-resident, they're still going to be taxed when you come back to the UK. And the rules are going to be beefed up. So some things like loans made while you're non-resident might be taxed as if they were dividends if you come back early. Some indirect payments. So if a payment is made to a third party and you benefit from it, and then you come back early, you can be taxed. Quite a lot there. So worth bearing in mind. Protected cell companies, some nefarious tax advisors, none at Saffery's of course, have noticed that if you have a protected cell company, which is one company, I think you can do them in Jersey and Guernsey, but one company which has lots of different individual cells, then some of the tests, which apply, some of the anti-avoidance rules don't apply terribly well to those structures. So for example, if you've got, if an overseas person holding UK land through a corporate, then a sale of the shares in the corporate is only subject to tax here if the company is property rich. And so you look at all the assets of the company. So if you've got a protected cell company, you have to look at all assets across all cells. That's now going to be on a per cell basis. So if you've got a special cell which is set up just for your assets, you might now be caught if that cell is property rich. It's not mentioned anywhere, but it looks like the legislation also applies to Section 3, which is the 25% test. So if you own more than 25% of the company, and that company makes a gain, you can be taxed on that personally. Now that's on a per company basis, but it looks to me like that's now on a per cell basis. So again, those protected cell companies, if you've got clients who've got them, have a look and spend more time looking at the legislation than I was able to at 1 a.m. But yeah, it might be sort of significant changes there. Very, very briefly, because I think we're tiring of international private client tax, if that were possible. A couple of minor points. One is it won't be possible to do a voluntary NIC from April 2026 in order to maintain your pension rights in the UK. And secondly, there's going to be a change to the tax status of personal representatives. So if you're deceased, and will your executors be liable to capital gains tax on gains made by the estate? It now looks only at people who are UK resident for when they died, not long-term UK residents. So it used to catch people who'd gone non-resident and yet hadn't been non-resident for long enough to cease to be long-term residents. So that is retrospective from April 25. Oh, there we go. So some business tax. Well done. You're over halfway now, downhill to 9:30. So we have found, I'm delighted to mention, a Brexit benefit. So this is EIS and VCT tax reliefs were state aid while we were in the EU, and so we couldn't change them without permission from Brussels. Now we're free and an independent trading nation once again. The government is able to make technical changes to EIS and VCT without having to kowtow to Europe, and so has done so. So they have doubled the qualification criteria. So the investment limit's gone up from 5 to 10. Lifetime investment limit, so the amount that a company can receive in EIS qualifying investments, up to 24 million. The gross investment test has gone up has doubled as well. So EIS and VCT are going to apply to larger companies. That's going to be, I imagine, quite beneficial for the industry and really open up the number of companies who can look to raise finance. That said, there are quite a lot of structural issues with the EIS which haven't been looked at all. So, for example, if you've ever bought a share in a company, you can't get EIS on a further share. So straight away, a load of potential EIS investors in these sort of scale-up companies are not going to be interested in it because they can't get EIS because they're already shareholders. Their spouse can, under current rules, I believe, still. So that's worth having a think about. It only applies to ordinary shares, doesn't apply to convertible debt, doesn't apply to secondary market, only to new shares. It's really hard to structure a JV in an EIS company. It doesn't really work super well. So still some structural issues. It'd be great if those could be looked at, but, EIS bigger now. Numbers go up, so that's all good. One number which is sadly going down and is paying for this is the income tax relief given to VCT investments, going down from 30 to 20. So that pays for the additional EIS broadly. So that's all from April 2026. Capital allowances. Again, difficult to really see the policy goal here, but writing down allowances going down from 18% to 14%. So if you've got capital allowance pools which haven't been fully expensed under the new fully expensing rules, or you didn't get AIA on them the first time because they're either old assets or assets which didn't qualify for one of those sort of tax reliefs, it's now going to take a lot longer to get tax relief for the expenditure. And there's also a new first-year allowance for main rate expenditure of 40%. Again, probably a lot more limited than it at first appears, because corporates will be getting full expensing anyway on new investments, and unincorporated businesses get AIA on assets. So it looks like it'll be like leased assets and things like that. The government did say a while ago that it wanted to give additional capital allowances to companies which buy assets to lease out. So looks like what that is, all from April 2026. There are quite a few changes on employment taxes, but the only one I really want to cover is the umbrella companies rule. So the way that umbrella companies work is that if you're a client and you want some stuff, you go to a recruitment agency. They don't employ people. They go to the umbrella scheme, the umbrella company, who have all the employment contracts. And so the client pays the recruiter, who pays the umbrella company, who pays the PAYE for the person at the end, unless the umbrella company just disappears and takes all the money, and then is very, very hard to track down, in which case they may just take all the money, or they may just take the payroll taxes, which they should have deducted and paid over to HMRC. And so it's quite hard to track those people, and they tend to sort of phoenix, they disappear and then come back again. So from now on, the recruiter is going to be liable for the PAYE for umbrella agency companies, and if there's no recruiter, it's the end client. So this is going to apply to any sort of structure that employs temporary staff, I would have thought. And that is there's joint and several liability, so that's from April 2026. Another Brexit benefit, similar to the EMI schemes, so it's the EIS point, the qualification limits for EMI are doubling. So bigger companies can qualify, more employees can get EMI shares, and they can hold their share options for longer. Currently there's a 10-year limit on EMI options. You have to exercise them within 10 years. That's going to 15. So all of that's from April 2026. Again, larger companies will be able to qualify for those very, very beneficial sort of tax-efficient share options. You can also amend, so most options have in them a limit, so they lapse after 10 years. You'll be able to amend your option to extend the exercise period to 15 years without causing a loss of relief. So that's very positive. It's quite practical. It means it applies to existing options. That's all very beneficial. And also they're removing the notification requirement, which is excellent, because that is where EMI tends to fall over. Firstly, people forget to notify, and secondly, HMRC doesn't have any way of proving that you have notified. So if you're selling a business and you've got EMI option holders, you cannot prove to the buyer that those EMI option holders have been validly notified and therefore qualify for the relief, unless you've taken a sort of screen grab of when you did it. So possibly this is because of HMRC's systems being poor, but nevertheless, there it is. The notification requirement's being removed from April 2027. What I don't know is whether that is, because you have to notify after the end of the tax year, so I don't know whether that applies to options granted after April 27 or options granted after April 26, which would have been notified after April, I don't know. So watch this space on notification for EMI options. The value of the options hasn't changed. Still 250 grand per person per company. I don't think that's changed in the 21 years that I've been working in tax. I did an EMI. I think one of the first things I ever did at Saffery's was an EMI scheme for Jason Lane for one of his clients, and I'm pretty sure that reached the 250 grand limit. So that hasn't changed. So there you go, unfortunate. One thing I forgot to say on the EIS slide, but also applies to the EMI, is because Northern Ireland is still in the EU, sort of, none of these changes apply to Northern Irish companies. So the EMI changes and the EIS changes don't apply to Northern Irish companies. So that is something which will sort of turn around and bite you at some stage in your career, I'm sure, but just bear that in mind, that because of the EU state aid thing, they couldn't do it for everybody. For other share schemes, SIPs and Save As You Earn, there was a big call for evidence, which took place earlier this year. It turns out that the people who use the schemes quite like them, but they would quite like the holding period to be reduced from 3 years. So the government said they are keen to improve the schemes, so watch this space. In your notes, there's loads of stuff on EMI, it's not EMI, on VAT, which I have condensed to one slide because I don't know very much about VAT. Four things on VAT. One is taxis are going to get more expensive because Bolt won a case earlier this year saying they should only pay tax on the margin that they make on their ride-hailing rather than the price, because they're a travel agent. So the government is not having any of that and has legislated against it. So that means that VAT on Uber and Bolt and things like that is going to go up. Whether they pass it on, I don't know. E-invoicing is going to be mandatory from April 2029 for VAT. That's for business to business and business to government, not business to consumer. That's going to require a heck of a lot of additional IT spend for businesses before April 2029. The only country that I have experience in e-invoicing of is Italy, which was not the most straightforward thing ever. So hopefully it will be a bit easier than that. Land for social housing is actually pretty big, actually. So there is currently a thing whereby if you're a housing association and you want to build social housing, and the person you're buying the land from has opted to tax it, and so he's going to charge you VAT when you buy the land, you have no way of getting that back because you are building housing for rent, and so it effectively, which is exempt from VAT, so you are your cost of your land is basically up 20% than it otherwise would be. There is a solution to this, which is a bit sort of Heath Robinson, which is that the house builder buys the land, does just enough work on the land so it qualifies as a house, and then they sell you the half-built house to the housing association. That's called golden brick planning. It's very tax inefficient because you have SDLT and corporation tax at the development company level, and what is half a house? I don't, and there are other issues that Homes England won't release all of the money until you actually own the land. So it's quite a difficult situation, which is genuinely impacting on the building of social housing, and the government have said they're going to look at it, which is progress because Sean McGuinness, our head of tax, has been banging the drum on this for about 10 years. So it's getting there very slowly. Zero rate for goods donated to charities, which will help businesses give surplus stock to charities. So that's April 2026. That's a good thing. And help for retailers who are competing with people sending cheap goods from abroad. Our transfer pricing team were beavering away on the transfer pricing changes and produced 9 pages of notes on this subject last night. There's an enormous amount of incredibly technical stuff on transfer pricing, all of which is far too erudite for me. It's extremely difficult, but there's loads of stuff on transfer pricing in the budget. The bits that I could understand are 2. One is that there's going to be an exemption for UK to UK transfer pricing for periods beginning on or after January 2026. And secondly, that we're going to have a new tax return called the International Controlled Transactions Schedule, where you have to tell HMRC what specific information about cross-border transactions in a special format. So both of those things are happening, but loads of other things are happening on transfer pricing. It's extremely complicated. Please look at the notes for the very short version, which we cut down, but also speak to Dawn and her team because there's quite a lot going on. Briefly on stamp duty, I'm just mindful of the time. So there is going to be an exemption from SDRT, which is the stamp duty which applies to listed shares, for 3 years after a company lists on a regulated market, which is very welcome, I guess, but it only applies to companies which list on or after budget day or after budget day. I have no idea why they couldn't have applied it to companies which have listed for the last 3 years, but there we are, it's going forward. And there is a simplification where they're going to turn stamp duty and SDRT into a single tax called the Securities Transfer Charge, which has been talked about ever since I was involved in stamp duty, so since about 2015, but it's definitely happening this time, and so there's going to be some testing of that in the new year, which is positive. A couple of other points on business tax. One is we're going to get a piloted R&D tax relief advanced clearance service. There is already a voluntary scheme, but apparently it is not well used. So there's going to be some experimentation with mandatory advanced clearance for R&D tax relief from April 2026. And the corporate interest restriction is an extremely complicated way of reducing interest deductions for large corporates. There's quite a few hoops to jump through, and one is that if you're a group, you have to nominate a single company for your group to report, and you have to notify HMRC of that. And if you forget to do it, your corporate interest restriction return is invalid, and you might have to not only pay a penalty, but not be able to use your losses in the best way. So that you'll now be able to backdate that nomination, and you don't have to do it by notice. You can just act as if you had, but there's an authorization process which is now annual. So just there you go. And then very briefly, and thank you everyone for your patience this morning, I've got a few points on admin and enforcement. Firstly, the late filing penalty for corporation tax is going to double from 1st of April 2026. So there you go. Those were the old ones, and some new ones there on the right-hand side. And late payment penalties for income tax and VAT are going to increase from April 2027. I couldn't find a table in the technical notes because there was no individual technical note on this, but watch this space for late payment penalties increasing from next April. And 2 more slides to go. New powers for the government to tackle construction industry fraud. No details as to what they are, but they are going to be there. A whistleblower charge, which which is likely to be quite controversial. So if you inform HMRC about high-value tax fraud and they collect more than 1.5 million, you, the informer, will get 30% of the tax collected. I can see an employee of Saffery grinning at me in the audience, which is slightly worrying. So there you go. That is going to be a thing. Automatic receipt if you tell HMRC about it, and some new powers for HMRC to close in on, which is a slightly disturbing image, promoters of marketed tax avoidance. So much easier for HMRC to DOTAS penalties, and then new powers for the government to prevent promoters carrying on with schemes which they don't think will work, but also a promoter action notice, a PAN, which means that if you supply services to a business which has had a stop notice in respect of a scheme and you ignore it, you can be ordered to stop providing services to that business. So if you're an insurance company and you're insuring tax avoidance schemes and the scheme has been stopped by HMRC, you can be stopped from providing insurance services to that promoter. Social media companies can be prevented from running ads for that promoter. So let's see if those work. So it sounds good, but there we are. And there'll also be some additional information powers and the power to name and shame legal professionals, which is jolly nice. Finally, in this area, mandatory registration of tax advisors. This is anyone who interacts with HMRC in respect of tax on behalf of a client, which looks like it will apply to conveyancing solicitors, for example, filing SDLT returns. It's quite a broad rule. Not only the firm has to register, but also senior managers within that firm have to register with HMRC. There can be penalties for the whole firm if a senior manager either fails to register or acts inappropriately. So it is it's quite a lot there for anybody who deals with HMRC on behalf of a client. Starts in May, and there's a transition period. So yeah, something to bear in mind. So that's the end of the webinar. Thank you very much, and yeah, I appreciate your attendance. Thank you.